Options are an awesome way to generate income for yourself and a great way to be active while you're waiting for stocks to come down to your price. First thing I want to talk about are what we call covered calls. These are positions that you own the stock, and what you're trying to do is generate income on top of that. Maybe you're trying to keep the shares but generate a little bit of income on top of it, or you're trying to exit the shares at a certain price. I'm going to use the example of Apple right here. This is arguably one of the best stocks in the world, one of the best companies in the world, and we can, at the current price that it's at, if you own the shares, let's say maybe you want to sell them at $175 a share. We're going to look at that. Maybe you don't own Apple, but you want to, and maybe you want to buy it at about $130 a share, but you don't want to buy it anywhere above that. There's ways that you can generate income for yourself on the way going both ways. So the first thing that I'm going to do is look at those covered call positions. Let's say that we own shares of Apple right now, and we're currently up, I don't know, let's say you're up 100%. There's a lot of people out there that have made incredible gains on Apple over the last couple of years. Current price is $163.67. The first thing that I look for when I'm going to write a covered call is I go and look at the earnings date. We all know that earnings can send stocks on wild rides, warranted or not warranted. But I always like to go before I write a covered call and find out the next earnings date. And that earnings date for Apple is October 27th. So today is September 12th. I know that if I'm going to write a covered call on Apple, no matter what the price I go for, I want that thing to expire before the 27th. So I'm going to come over here to the Webull software. I like using Webull because it has a great options chain. I don't have any money in Webull. I would never put money in Webull, but I think they have a great options chain, and it's something that I can display for you guys to see. All option chains are going to look very, very similar as far as numbers go and Greeks go. Colors will be different, etc. But let's just take a look here. Covered calls. So I'm going to go out that we can typically, you'll see now, for example, if you look at the S&P, you might have options expiring every day, every other day. For companies like Apple, they're pretty much going to be expiring every single Friday. So for me, I'm going to look at this and say, okay, October 21st is 39 days away. So I am going to click on that date and scroll down and see what options are out there. The way that I like to look at this is I look at something called delta. And in layman's terms, basically what delta is, the chance based on this moment in time, the chance that that event occurs. So looking at a covered call, this is what we're going to go for. We own Apple at, call it $100 per share. And we are comfortable exiting Apple position at, we're going to call it $190 per share. So if Apple gets to $190 or anywhere above it, those shares are going to get called away from us or taken away from us. Now, in the meantime, we're going to get some premium. And when I go back to the chain, you'll understand where that premium is coming from. But what is the risk about this? We know that we want to exit these shares at 190. So the risk is that the shares go above 190. Say they go to $200 by the time of expiration, whatever date that we choose. Well, we're not going to get that $10 difference in between. So the risk is opportunity cost. You're missing out on what you could have made. But if you were comfortable selling it at 190, for example, then you're not really risking anything. You would have gone in there and executed the trade by yourself at $190 per share. So that is the theory behind why we sell covered calls. Let's go over to the chain, and we're going to look at that 190 number. So I highlighted $190. And let's look at our delta. So our delta for this is going to be 0.038%. So what that means is there is a 3.8% chance that this event occurs. And that event being by October 21st, 2022 at 4 p.m., Apple will be at or above $190 per share. That is exactly what that means. Now, in the meantime, we talk about how we're going to generate income. Now, where is that income going to come from? Well, an options contract is a contract between you and the market. You're saying that I am going to take on this risk to sell my shares at $190 or above on October 21st, 2022 at $190 or above, like I just said. So what am I going to get for writing that contract? Well, right now, I'm going to get right here. I'm going to get about 18 to 19 cents per share. I'm going to say that we're going to get 20 cents per share just to use whole numbers. So 20 cents per share. So if you own 100 shares, you get 20 cents for each share that you make. And they are going to take that money because you're selling them an option. You're selling them the option. They're going to take that money and put it right into your account the second that you make that order. Now, when you make that order, you are making an agreement with the market that they can take those shares away from you on that date or before. That can happen. They can take the shares away from you before. Doesn't happen frequently. I've been selling options for about 28 months now, and it's happened to me one time. And it's because I was so far out of the money, it didn't even matter. They were going to take those shares away from me. Now, what happens on, let's put it two ways. This is a common question that I get. What happens if on October 19th, Apple is at $190.15 per share. What happens? Do your shares automatically get taken away from you on this date? And that answer is no. Can they be taken away from you? Yes. If you're 15 cents above the price, you're probably not going to get those shares taken. But the point of me saying this is, it matters where the stock finishes the day at. So on October 21st, this thing goes 21. This thing goes to back down, say $188 on the nose. Well, you keep your 20 cents per share. You go home, contract expires, and you are good to go. You kept the premium. Either way, no matter which way you spin it, if you let the entire contract expire on the 21st, whether you lose the shares or keep the shares, you keep that 20 cents per share. So it kind of changes your cost basis. So if you got those shares taken away from you, you would have actually lost the shares at $190.20 because you got that additional 20 cents. So that's the idea behind selling covered calls. You can always find a way to generate income. And let's say you didn't want to lose the shares. Well, that would be even easier. You can come over here and say, you know what? I don't want to lose the shares at 190, but I think that there's look at this, $175. There's a 22.7% chance that event occurs. I look at options and I say, if I don't want to lose shares, I'm not going to sell them in this area. I'm going to sell them at probably 10% or 10 delta or below because I want to keep those shares. I do not want to lose them. If I really want to get aggressive, let's say this Friday, I want to sell my shares of Apple and I want to sell them at $165. That's where I'm comfortable selling them. Well, for waiting 4 days and not executing the trade right now, they'll give me $5.60 per share. Now, there's a 49% delta, the 49% chance that happens, that event occurs, that you will be selling your shares at 165 or above. That is exactly how you can generate real premium if you want to sell on that day, if you like that price. So that's a great way that you can generate even more income and exit a position. Now, let's go to puts. When we look at puts, we are looking at acquiring the shares at a lesser price. So we know right now this is at $163.66. Let's say you think this is overvalued. You don't want to play with it, but you do want to own these shares somewhere in that 130 range. Well, just for waiting, you can get paid. And this is a great way of looking at it. So let's go over to puts right here and let's scroll down. And let's say you're comfortable owning the shares at $130. Again, I'm going to go on that October 21st date because earnings are the 27th. I don't want to play with them. I don't want to have to see what happened with Facebook. Facebook was at, $250 a share. Maybe it was $300 a share, whatever it was. And the stock price dropped 40%. And people got assigned tons and tons of options, including myself. So I don't play that game anymore. I look at this and say, let's go with that October 21st date. Same thing applies. You look at Delta. Right now, there's a 0.04 or 4% chance that this event occurs. Your Apple will be at $130 on October 21st of 2022. Now, what does this all mean? There is a way for you to make money on the way down or just waiting. You are going to get paid if you write this contract, 40 cents for just waiting this 39-day period for Apple to get to that price. So let's pull up our whiteboard again. The idea is you're writing a contract that says Apple's at 163 currently. I'm at 163.33. You're looking at it at 130. What you're doing is writing a contract with the market saying if Apple gets to $130 or less by October 21st, 2022, they have the right to put those shares into your hand. Okay? So that thing comes down. Let's say October 21st, the stock price gets to $132 or $142, or it stays up here. It doesn't matter. You are going to keep that 40 cents per share that you wrote, and your contract's going to expire worthless. You're going to move on, and that is how you can generate that extra income. Now, let's say that Apple moves down and it goes to $129 by this date. You are going to get assigned shares at $130 per share. So what is the risk of puts? The risk is that you get assigned the shares very underwater. Let's say, for example, by this date, Apple is at $75 a share. Well, you just got assigned the shares at $130. So you are instantly in the hole a very, very big number. Now, that's a risk. That is absolutely a risk. But here's the idea behind it. If Apple got to $130 a share, I would be going on to my Schwab app and I would be executing shares to buy at $130. The idea behind the way that we sell cash secured puts is we only sell them on companies that we want to own. So I'm not going out there and looking at this and selling puts on Rivian or some other company. I do have puts right now on Tesla. And my puts right now on Tesla are probably $75 or something like that, expiring in January of 2023. But that's because I want to own Tesla shares at that price. Is it going to happen? Who knows? But I'm not going to go out and sell puts on companies that I don't want to own. So that's the general idea behind this. The risk is that you're down here losing money on your put. But it's really not that risky because you would have been buying shares at 130, 110, 95, all the way down to that 75 number. And that is the idea behind the way that we sell cash secured puts. So with that being said, let's go and look one more time at that options chain and just make sure that we have this. So $130, and even now you can collect 41 cents a share. 41 cents a share, that's going to go directly into your account. So however many shares you have, 41 cents per share, and you are going to wait till that expiration date of October 21st, 2022. It is a great way for you guys to generate income, especially if you are a person that is getting really close to retirement and you have a big pile of cash and you're invested in the S&P 500, or you have 10% of your money and you're just picking general stocks. We have somebody in our community. He has a 7-figure net worth. He sells puts and sells covered calls every single month, and he generates between $5,000 and $7,000 per month. And he has not been assigned shares because he knows how to do them correctly with the deltas being so low. And if he does get assigned the shares, he's very happy owning those shares because those are companies that he would have already bought. And on the top side, you can go and attack covered calls and you don't have to worry about losing the shares. If you don't want to, you just write much lower deltas. If they do get executed or they do come into execution, you can go into rolling them, and there will be many, many more videos on options, especially in the Bid and Ask Nation. Guys, for more on my process, click this link right here. Go watch the next video. Trading, options, value investing. Catch you on the flippity flop.